Hello, good evening, everyone. Welcome to today's webinar, Meet Author Asia Stock Markets from the Ground Up, Herald van der Linde, hosted by CFA Society India. I would like to take a moment to welcome our audience from around the world joining us remotely. My name is Pranav Bhavsar, and I'll be the moderator for today's webinar. Before we begin, some housekeeping notes. Today's session is scheduled for 60 minutes, including Q&A. We'll be leaving time for Q&A after the session. Please feel free to submit your questions throughout the session. You can do so by clicking on the Q&A link at the bottom of the viewer and typing in your question in the box. We value your feedback, so please take some time to complete the evaluation survey before you sign off today. Just a bit about our speaker for this evening. Now it's my pleasure to introduce our speaker for today's webinar, Herald van der Linde. Herald is HSBC's Head of Equity Strategy Asia Pacific. He joined the bank in 2005 and came to HSBC with 20 years of experience in various roles, including stock analyst, equity strategies, and country head of research in Indonesia, South Africa, and Taiwan. He is a chartered financial analyst, CFA, speaks 7 languages, and has an MSc in economics, for which he wrote a thesis on Indonesia's central bank in Jakarta in 1993. Herald is also an associate of the Institute of Wine and Spirits and is a certified lecturer for Wine and Spirit Education Trust. Over to you, Herald.
Yeah, thank you very much for that very nice introduction, Pranav. I'm going to share my screen here. So that takes me a second and bring up the presentation because you're right. I joined HSBC with some experience in Asian markets already, but at the moment, actually, I've already done over 30 years of Asian equities. That has culminated in a book, and the book is really for people that, I'm going to put up a QR code here to a link for those people that want to look it up in India. It's available on Amazon.com. The book is really actually caters for people who have no financial background but are interested in Asian stock markets. We see an increased interest by, let's put it like that, ordinary people that haven't studied finance or have got a CFA that are interested in stock markets, and as such, the book provides some background to them. But I also think that if you do have a finance background, using your finance background and the book and combining the two would actually basically tee you up to become a portfolio manager for an Asian portfolio. So if that's something you aspire to, or you want to be actively involved in these markets, I would really recommend to buy the book. Now, you would say, that's what all authors said, but I do want to highlight that the proceeds of the sales of this book go to a charity on financial literacy. So it's not that I'm trying to make money out of this. Indeed, writing a book is extremely time-consuming, fun to do, but the aim was not to make money out of this. So this is a QR code to Amazon, and this is a QR code to some other ones. The presentation will be made available to you in case you want to take a look at it, but this is the international websites, and this is the book itself. Also, before I kick off very quickly, HSBC has a weekly publication called Week in China. It is free. It is a magazine that's for free and looks at what happens in China. So if you want to keep on top and you're outside of China, like most of you will be in India, this is a very easy way to do that. It's very easy to read. It's not about finance either, but it's just stories that have got the headline. And there might be something of interest to you as well. If that is the case, use these QR codes to look at Week in China. And with that, we're going to look at how Asian stock markets work and answering the questions that you have. And one of the questions is, why would you actually have to invest in Asia? Why not stick with the S&P 500? And this is quite a common question that I get. If you look at performance of emerging markets of Asia over the last 20 years, it actually doesn't look so good, and it's underperformed the S&P. So why Asia is supposed to grow faster? Why haven't the stock markets done better? That's something I get, and that's actually, as you will see throughout the presentation, a misunderstanding of what Asia really is and how it works. And in order to get to that understanding, we step back in history and we go back to a rainy day on 1602 in the city of Amsterdam. And this is a painting of Amsterdam in that town. I don't know if you've ever been there. There's a train station that you get into. You walk into the city. That train station would be in the foreground here. There's a river here with boats in the front, and these boats would go all the way to mostly Indonesia, but also India, Goa, Sri Lanka in those days. That was the Dutch East Indies Company, to trade in spices. And we're going to zoom in into this particular picture because it's important. If you look in the middle of this picture, beyond the boat, you see a small bridge there. And we're going to go to that particular bridge because what happened is that the company, the Dutch East Indies Company, made a financial innovation. It decided that it needed money to get these expeditions going, and it decided to issue shares. Now, the way this happened is as follows. The Portuguese were actually the first that ended up in places like India, and very prominent still, right? In a sense, Portuguese culture in Goa. And the Dutch followed later, but the Dutch were a little bit of an unorganized bunch. Different cities had different people that came together. And what they did is that people with a bit of money would come together and say, let's get a ship, get a captain. He gets a crew, let them sail off. They would finance the whole thing and hope that 2-3 years later, the boat would come back with all kinds of treasures, right? So there would be cloves and cinnamon and cardamom and whatever from Indonesia, from India, and these sort of places. And then sell it off, and that's where your profits came from. So the Dutch different cities did this, and that wasn't quite helpful. They started to compete with each other. The city of Amsterdam would block, for example, the province of Zeeland when it arrived in Goa, and that gave an advantage to the Portuguese. So the Dutch eventually came together and said, we can't do this. We are competing to each other. The Portuguese are eating our lunch. We need to combine everything together. So instead of just financing one expedition, which also had the risk that the boat would never come back, piracy, bad weather, you name it, you could lose all your money. They said, listen, what we're going to do is the people that want to participate, we're going to let them participate in all the expeditions done by all the cities in the Netherlands. There were 5 or 6 cities that were active in this. All the cities, all the expeditions for the next 21 years. Why they picked 21 years is a mystery to me. I haven't figured it out, but it doesn't matter because after 21 years, they continued anyway. And what that meant is that they then said that anybody who wanted to put some money into it would get a certificate. And literally, people lined up on the 1st of April, funnily enough, the 1st of April, 1602, at a house in Amsterdam and said, well, I'm going to put in the equivalent of what is maybe now 10 euros, and somebody put in 1,000 euros, somebody put 10,000 euros, somebody only maybe 2 euros, and all of that was written down. And they made a very important decision that they said, if you want to sell that, you can actually sell that. You got to find somebody else who's willing to take your stake. Come back to us. We have the books. And then we say, okay, Mr. Peter put in equivalent of 1,000 euros in those days. That is now, that 1,000 euros is now owned by Mr. let's say, Mr. Hendricks. And not Mr. Peter anymore. So they would keep that in the book. So these shares became, and this was the financial innovation, tradable. But where do you trade? Now they traded on that bridge. That bridge actually still exists. Of course, not the wooden bridge from 1602. It's now a cement bridge, but I was actually there a couple of weeks ago. So people would meet on the bridge. That was the agreement made. Now that's a really bad decision because if you know anything about the weather in Amsterdam, it's pretty much the same as in London. It rains. So people would try to find buyers, sellers would try to find buyers, and buyers would try to find sellers on that bridge. But of course, they would, as soon as they meet, they would go into the cafes next door. So they would gather in the cafes, and eventually it became so crowded that these cafes said, well, it's a bit too busy for us, and you guys are not drinking enough. You need another building. So they constructed a new building, and they called that building the Wallet. And in wallet in Dutch is beurs. And this is why stock exchanges are still called beurs sometimes. And you can see on this painting in the background, you see a tower on the left. It's called de beurs. That is the stock exchange, the very first stock exchange that ever existed on the planet. And some of those certificates that were tradable in those days, we can still find them in archives. This is the oldest share certificate on the planet. And on one hand, you can see it's written, or if you know Old Dutch, it says Mr. Peters, and put his, I think it was 150 guilders at that time. So that was proof that he put money in. And on the other hand, is on the right-hand side, you can see for each individual year that dividends were paid, how they were paid. There were sometimes bags of maize or cinnamon or cloves and these sort of things. And sometimes it was in cash. So this is the oldest share certificate in the world. But what is important here is that putting everything together in a basket, so that's risk diversification, that happens in a sense. You didn't have all your eggs in one expedition that a boat might never come back. But also, you now, having money in there, you had right to all the dividends over the first 21 years, and it turned out after 21 years, as I said, they continued. So you had right to a stream of dividends. Now, if you don't know anything about finance, normally then I explain them that a future payment is not as valuable as a current payment, so that you need to discount that. But if you know finance a bit, you know this is effectively a discounted cash flow. It's a DCF. And I think stock markets need to be approached as DCFs. And the key input in DCFs is the stream of dividends that you get and the discount rate that we attach to that. And that very often is a bond yield or something like that. So I go through a bit of pain to explain it to people how a DCF works without using the word DCF. To non-finance people, what we are here, people from a finance society, and I presume that most of them know what a discounted cash flow is. But effectively, future cash payments are being discounted back to some present value and added up to create a total value of a company. And this is how we have to look at stock markets, I think. You have to look at them from the ground up as the aggregation of the discounted cash flows for each of individual company that is listed there. And that is important because that sets the structure as well of how we think about stock markets. On the one hand, you got team green, which is profits. If profits go up, that's really good. If profits go down, that's not good. And then there's team red, that is the discount rate. If the discount rate goes up, that is not good for the valuation. And if the discount rate goes down, that is good for valuations. And it's not just profits now, but it's also future profits. And this is where I think very often a misunderstanding comes through with stock markets. People say, oh, profits are really bad this year, they're being downgraded, but the stock market goes up. Well, it could be that future profits are being upgraded and or the discount rate goes down. And that could lead to a lift in stock markets, even if you see current year profits fall. And that happened, for example, in the beginning in 2020 when the pandemic arrived. So what has happened with the profits and what has happened with the discount rate? Now, that's shown here. The average earnings growth in Asia over the last, say, 15, 20 years is about 14%. That is not bad, but we're growing much slower at the moment for a variety of reasons. China is slowing much slower, but India is actually doing a bit better than that. So that's something we keep in mind. Funny enough, it's not as fast as the S&P. The S&P has also grown on average over this period by about the same, actually. So Asia has not grown faster. Asian aggregate has not grown faster than the S&P 500, the US market. And then we have bond yields that have come down here. You can see bond yields have pretty much come down stepwise almost, sometimes go up and then eventually go down again. Over the last, almost 40 years now, since 85. That's an awful long time. And why has that happened? Well, there are structural reasons for that. Demographics, people are older, aging, they save more. That means there's more supply of savings. But also, we've seen deflation. Technology has been deflationary, and that has lowered interest rates over the longer run as well. And that's something to keep in mind. Now, with lower bond yields and with decent earnings growth over time, you would expect Asian markets to go up, and that's exactly what happened. Now, these numbers are slightly outdated, but still illustrative. What it shows here is that the Asian market, at least until, say, when I made this chart in 2000, a couple of months ago, Asian markets did about as good, or maybe a little bit less, than the S&P 500 since 2020, actually. So, since 2000. So Asia in general is slightly underperformed the US market, but it's gone up for the reasons I mentioned. High earnings, and a lower discount rate. But this is just part of the story. Why hasn't Asia done much better, you would ask? And let's go through the individual stories. Now, just to put this in context, this is the Asian stock market universe that we're going to look at. A whole bunch of markets here. Not going to go into detail. I'm not going to talk about, for example, the Dhaka Stock Exchange in too much detail here. But here we put them all together, trading activity and size. You can see the US outsizes all of the market, but China is pretty big and liquid. That is China onshore. You can actually add Hong Kong to that, and then China and Hong Kong together becoming quite sizable. And actually, there are more and more companies coming from the US into Hong Kong. So Hong Kong is growing as well. It's not far off actually from the US anymore. Then you got Japan, Korea, Taiwan, and then India. You can see India is quite big for in particular for the trading in that particular market. So India, in terms of scale, would actually be about as big, or maybe even closer, bigger than Japan now. And then you got the ASEAN markets there. Now, these are the different markets. And quickly on correlations, again, this is very often a presentation I use for people who know nothing about finance. So with the two dogs, I try to explain that two markets might be different, but still look a bit different in the way they behave. And what is important here is that the correlation of certain markets, for example, Korea, Singapore, but also Taiwan, is pretty high. Well, for other markets, Bangladesh, Shenzhen, so the Chinese market is much lower. And actually, India is reasonably high, but it's actually dropped more recently a little bit. It's really Korea, the export markets, as we'll find out later on, that have high correlation, and China and Bangladesh, amongst others, have a low correlation. Now we're going to talk about the different markets across the region, and we kick off with the biggest of them all. That's China, Hong Kong. I've added Singapore in that as well. This is myself when I still had here backpacking in 1990 in Indonesia. I was going around Indonesia. People told me, go to China. I did that. My first day in China was quite disastrous. I was in a plane crash in the afternoon, but in the morning, and this is more important, I changed my money. I had US dollar. In those days, you still have traveler checks. I went to a bank in China. They then gave me not renminbi, Chinese currency, but they gave me what is called foreign exchange certificates. And one foreign exchange certificate was as much as one renminbi. So if I had $100, I would get about, say, 800 foreign exchange certificates. And then on the street, people wanted that stuff because that was stuff that you could buy TVs and radios with in Hong Kong. So people would come to me and said, do you want my renminbi? And they would offer me 900 or 1,000, sometimes 1,100 or 1,200 renminbi for these 800 foreign exchange certificates. Why am I telling you this? Because this is important. Money in China, China's got a closed capital account. Money in China is different than Chinese money outside of China. That means money can't leave China. The renminbi is for the Chinese people. If you're as a foreigner in the past, you could not even get renminbi. Well, you could trade on the black market as I did, but you would get foreign exchange certificates that you could only use in particular stores. That is important because that means that the discount rate in China, the bond yield in China, is different than the discount rate outside of China. Now, it's getting a little bit more complex even than that. China's got a couple of stock markets. In China, you got the biggest one, Shanghai and Shenzhen. There's actually one in Beijing now as well. It's quite small, but Shanghai and Shenzhen. Shanghai is called the Asia market. And then you have Chinese companies that are listed outside of China, mostly in Hong Kong, but also some of the US ADRs. The Hong Kong ones we call H shares, and in China, Shanghai, we call A shares, A. Now, you might have the same company that is listed in Shanghai and Hong Kong. So the profits of this company would be the same. But remember that we said you got to think about stocks and stock markets as a red and green team, right? A profit team and a discount team. So the profits might be the same, but the discount rate is different because the liquidity in the China is different than the liquidity outside of China. So the discount rate might move in the opposite direction than, say, in Hong Kong. So you can have the same company that on a particular day in Hong Kong, the share price goes down, but in Shanghai goes up, or vice versa. So we've got to keep that in mind. That's very unique. And we call that difference the AH share difference. So there's something to keep in mind. Now that's for the same company, but also the stock markets are different. And we'll talk about this in a second. So if people say, do you like China? I have to ask them, what China are you talking about? Are you talking about Hong Kong or the companies listed in New York, the ADRs? Or are you talking about Shanghai and Shenzhen? There's quite a difference there. And not just because the liquidity, the discount rates are different, but also the composition of these markets are different. Now, these are how they performed. Shanghai, Shenzhen, and the Hang Seng China Enterprise, that is the Chinese companies listed in Hong Kong, over the last, say, 20 years. You can see actually that the Shanghai market has done much better than those listed in Hong Kong. And actually the Shenzhen market has done even better. Remember that the Shenzhen market almost made $1,000 if you invested $100 in 2000. And remember that same amount of money would have grown to about, say, 470, close to $500 if you put it in the S&P 500. So the Shenzhen market has done twice as good as the US, and the Asia market has done somewhat better than the US, but the Hong Kong market not. So we already see that, yes, we said earlier on, Asia might not have done as good as the S&P 500, but actually in Asia, Shenzhen market has done much better. We'll find out later that another market very close to you, as India, has done actually much, much better than the S&P 500 as well. Now, why is that the case? Why are these differences? As I said, not only the discount rate difference, but also the markets, the composition of these markets. Look at the HSCEI, the top 10 names here. The first one is a tech company. The second one is a tech company. The third one is a tech company. The fifth one is a tech company. Tech dominates. The H-share market, that is the Chinese companies listed in Hong Kong, that is really kind of a new NASDAQ of Asia, you could say. While the companies listed in Shanghai or Shenzhen, SSE, Shenzhen and Shanghai exchanges index, those are what you can call traditional company. The first one, Huitai Motai, is a liquor company. Then you have a bank, insurance, a green technology company. Then you got a healthcare company. Then you have another IT company, tourism company, very traditional sort of businesses. So the A-share market in composition is very different than the H-share market in Hong Kong. And that's summarized here as well. And that means that the market's composition different, but also the discount rate changes. The profit that is generated in these markets is very different, and the discount rates are different. So you got two stock exchanges that really can perform very differently, and that's exactly what we've seen with the Asia market being much less much more. It's got less financials and less tech than the Asia, the Hong Kong market, and that means also the way it behaves. For example, the correlations are different. The HSCEI, that's the Hong Kong market, H-shares, as I mentioned, got a much higher correlation than, for example, Shenzhen with the S&P 500. And the market concentration differs quite a lot as well. I'm not going to delve into that too much, but there's a couple of other markets where this is much higher or lower, and highlight that. Why do we look at market concentration? Because it means that the top 5 or 6 companies, comprise a lot in that market. So you only really have to look at those stocks in order to understand what happens in that market. Now, geopolitics plays a role here. The US is making it difficult for Chinese companies to be listed in the US. So some of them are moving back to Hong Kong. And that means that the Hong Kong market in particular is becoming really, as we call it, a NASDAQ of the East. Now, that allows you to understand the Chinese market structure a bit and why it behaves as it is. And as I said, in Hong Kong, we're moving from property towards a tech market, a NASDAQ of the East. But this is also taking place in Singapore, where some of the ASEAN tech companies are being listed. And actually, India is a good example as well, where tech is really coming to the forefront. And that changes the composition of these markets, but also the way these markets are behaving. That's something that we need to keep in mind. Now, we've spoken about Hong Kong, about China, but I also want to touch quickly about Singapore, because Singapore is a different ballgame altogether. Look at the top 10 stocks in Singapore. Bank, telecom, bank, and then real estate, and then after that it goes on bank, real estate. And banks and real estate are very interest rate sensitive sectors. If interest rates go up, that's good for banks because they can price higher charges for their loans. It's bad for real estate because mortgages are more expensive and vice versa. So the Singapore market has traditionally been very much dominated by banks, by real estate, and therefore very interest rate sensitive. And with the tech companies coming up, that is shifting a little bit. But it's got a very unique set of companies listed in that market, which I'll touch upon in a second. See, the Singapore market, if you were to put $100 in the Singapore market in 2000, again, the S&P 500 would have made you $472. By the end of 2021, the Singapore market only 234. That's actually pretty disappointing. So it dragged the whole of Asia down. It's done much worse than, for example, some of the Chinese markets. But within the Singapore market, there's a group of companies, and those are the REITs, the real estate companies, the real estate investment trusts, that have actually done pretty good. $100 there would have more than almost gone up 5 times, more than 4 times at least, in the last, say, 20 years or so. So that real estate is really an emerging special sector in the Singapore market to keep in mind. And that means that, yeah, that because the interest rates follow the US interest rates, and it's an interest rate sensitive market. So it follows, yeah, the market follows what happens in the US to a certain extent, therefore, as well. It means, therefore, that the Straits Times, the Singapore market's got a very high correlation with the S&P 500, so one of the highest in the region. Now we're going to look at Korea and Taiwan. Those are markets where hardware tech is being made. And hardware tech is the fast overriding sector, in particular in Taiwan and Korea as well. They make chips, computer components, communication components, and all these sort of things. Very different than the tech you have in India, which is IT-driven, software-driven. And you export that across the whole world. You sell it into China, into Europe, into the US. Those are your real big markets. So if people tell me, oh, interest rates in Taiwan are going to go up, what do you think the impact is on the Taiwanese stock market? It has no relevance to the Taiwanese stock market because the Taiwanese, what they sell in Taiwan is very little compared to what they sell into the rest of the world. So these are the key names. If you look at the top names, it's all tech names here. I suspect in the list of the top 10 names in Korea, the KOSPI, you will probably identify at least 1 or 2 companies that you say, I know these companies, I know the brand. Samsung would be well known. I suspect LG Group, LG Chemical or Hyundai Motor, people would know that probably as well. If you go to the Taiwan index, most people would not have heard of any of these companies. The Koreans are tech, but they build brands. The Taiwanese are tech, but they don't build brands, but they're really good in what they're doing. Very different sort of approach in terms of making money to keep in mind. The key company, of course, in Taiwan is TSMC, the chip maker there, and Foxconn, which is part of the Honai Group, which is just announced is going to make some products in India in the future as well. But they're both tech, but very different way in approaching these businesses. Now, the top 5 companies are much more dominant in these markets. And those top 5 companies are tech companies. They're much more dominant than, for example, the dominance we see for the top 5 companies in China. And that exacerbates the linkages with the US market. The top 5 companies are exporters that sell into the US. And therefore, these markets have a very high correlation with the US stock market as well. You can see Korea has actually got the highest across the whole region. How have these markets done? Well, actually not as good as the S&P 500, although more recently, in the last couple of years, they've really caught up. So they've done much better in the last 5 or 10 years than in the years prior to that. Now, Japan is a very similar story, but very different. Look at $100 invested in Japan in 2000, only $148 by the end of 2021. That's not a lot. So again, Asia didn't do as good, but that's really because Singapore and Japan have dragged that down. A lot of the other markets have done almost as good or much better, actually, than the S&P 500. Now, that is dragged down by Japan. Why is that the case? No, Japan had a massive bubble in 1989. It popped and the stock market fell, and it fell all the way to late 2011. So part of the reason why it's done so bad is because it was deflation still taking place in that market until late 2011. Only after that, that market has done considerably better. Indeed, since then, it's been one of the better performance across the region. So a bubbles pop, you got to keep in mind it might take 1 or 2 decades for that to unwind in markets. I think Japan is interesting because it's on the one hand, like Korea and Taiwan, an exporter. And on the other hand, it's got a lot of interesting domestic companies as well and individual tech names that are really good. The key thing with Japan is that Japan has said that they will keep interest rates at 0, the 5-year bond yield at 0. That means that interest rate differentials with the rest of the world are determined by the rest of the world. Japan is 0, and then it's whatever it is in the US. Now, US interest rates have gone up. That means the interest rate differential is increased. That means that the currency is weaker, and a weaker currency is good for exporters. So the exporters outperform. If interest rates in the US go down, that might happen next year, the yen will probably strengthen. That is bad for exporters, good for importers or domestic companies, and therefore you would shift in that market as well. That is effectively the name of the game in the Japanese stock market. The Japanese stock market has the top companies are not as dominant as we've seen, for example, in Taiwan and Korea. That lowers their correlation a bit with the S&P 500 as well. And it's all about the exchange rate, as I mentioned earlier on. And now we're going to go to India and Asia. And those stories are completely different. Now, you guys are in India, so you will know the Indian story very, very well. What I tell people is that with India, you have to understand that India is not just a country, it's actually kind of a sort of continent. There are different parts of India that operate very, very differently. You can look at, for example, demographic data, birth rate, female labor participation rates, marriage, when people get married. The core of the story, I think, here is that India, because of its diversity, it also creates internal barriers. And over time, governments have tried to lower these barriers, tax barriers and these sort of things. But if you are, for example, born in West China or in East Indonesia, and you don't finish primary school, you can't hardly read or write, you can maybe still take a train or a boat to Jakarta or Shanghai, a train in China, and find a job somewhere there, maybe in a factory doing some easy jobs or something like that. In India, if you were born in, let's say, in one part of India, let's say in the far south, and you haven't finished primary school, you speak Tamil. Now you guys will know much better. If you go to Gujarat, there are not a lot of people who speak Tamil there. They speak Gujarati or Maharashtrian or Hindi or English. So because of its diversity, it makes internal movement of labor a bit more difficult as well, particularly for people that don't have a skill set. And that barrier is much higher in India than in China, where everybody speaks the same language, or Indonesia, where that's the case as well. And I think it's one of the reasons why India has not been as fast in urbanizing as much. Now, the top 10 companies, this is slightly outdated, but Reliance, this bank, India is a diverse market. It's got pharma, it's got tech, export, it's got domestic names. It is one of the most diverse markets in the region, actually. And that's shown in this particular kind of pie chart as well. While in Taiwan and in Korea, it's really one sector that dominates. That is not the case in India. That makes India, in my view, one of the most interesting markets to look at. And as I said, because of these internal things, India is still much more rural than some of the other markets as well. It hasn't urbanized as well. And that means that if you want to reach to the Indian consumer, it's not just about having a brand. It's about being able to reach there. And it's about having channels and getting there. And some companies have that and other companies don't. So you want to invest in channels in India, more so, I think, sometimes than brand or brand power. Now, that is the domestic story in India. Then, of course, foreign companies have tried to come in, and they've turned out to be quite difficult in the past. Ford pulled out, IKEA has struggled, and POSCO, eventually, Korean steelmakers, pulled out as well. India is not easy to get into. And that has a benefit because the companies that are operating in China, in India, and have the channels, they are extremely profitable. Indeed, Indian consumer companies are the most profitable companies in the whole region. And then it has pharma and IT. That's two areas where you guys excel in. And I know that in particular, on the IT front, there's been some news of some of the Taiwanese companies, Foxconn, starting to talking about opening facilities there. I think that's really good, but I think where India could really do well is IT design. I suspect that is a natural extension of the IT skills that India already has. So I wouldn't be surprised we're going to see a flourishing IC design, chip design industry emerging in India over time. So it's got domestic, highly profitable domestic companies, as well as exporters that are either unique in pharma or have a unique skill set in the IT sector. And the Indian market is not overly concentrated. As I said already, in sector-wise is diverse, but also stock-wise is diverse. That lowers the correlation with global markets, and that, again, makes India quite attractive as well. And then look at the performance. You put in, this is the Junjawala story to a certain extent. You put $100 in 2000, you would have nearly made 10 times your money in India over the last 20 years. It's been one of the best performing stock markets. So yes, Asia has not done in aggregate as good as the US, but take out Singapore, take out Hong Kong, and take out in particular Japan, a lot of these markets have done significantly better. And India is a great example of that. And I think India will continue to perform quite well on the back of that. And the story in ASEAN is somewhat similar. This is a picture of somebody, I think this is in Yogyakarta, Central Java. It is about not having just a brand, but reaching the consumers. Urbanization in ASEAN has been faster than in India, but still it's difficult to get there. The existing president, Joko Widodo, has put a lot of effort on putting infrastructure in place. And that means it's getting easier to get to these consumers. And not only that, these consumers, of course, like in India, they've all gone online. So it's now, as long as you got some website, the Indonesians are the most active users of Twitter and Facebook on the planet. So it's quite easy to get there. And we've seen some large tech companies emerge in the ASEAN markets as well, very often listing in Singapore or in Jakarta for that matter. And that's the interesting thing there. That market is more traditional. It has less tech companies than India. And these markets are more concentrated, more about banks and auto companies. They lack what India has in terms of pharma and IT, some of the export sectors in those markets. But they're still reasonably diverse, and in particular in Indonesia, the banks are big. And Thailand, oil and gas is quite big as well. So if oil prices go up, that's good for the Thai stock exchange, more so than other stock exchanges across the region. We've seen a lot of volatility in ASEAN, but actually the earnings volatility is not so high. So a lot of the volatility comes from the exchange rate and other factors that move around, not so much the earnings in these markets. And that's interesting to keep in mind, because if there is volatility and sell-off in these markets, and it comes from the currency and these sort of things, you got to remember, actually the earnings are stable. It allows you, if you're a bottom-up investor, to say, hey, this is the time to go into these markets. And these markets are much, much more concentrated. And that means domestic economies, the domestic economics is of importance, and that lowers the correlations with the US stock market. And again, that is an interesting feature that these markets have as well. And again, if you would have put $100 into, let's say, Jakarta, you'd have made $800. Not as good as India, but pretty good over the last 20 years. So these markets have done pretty well. Now, we've quickly talked about stock markets and to think about them as aggregate DCFs. We talked about all these markets, what the structure is. Very briefly, for me to wind it up, a couple of key demographics around the planet, across the region. First of all, no surprise to you, India very, very soon is going to be more populous than mainland China. In China, we see the population starting to decline. It is aging as well. That has all sorts of implications for markets. In India, still a volume gain. In China, it's increasingly a price gain, not a volume gain, because, well, there aren't so many Chinese around anymore. What is also is aging. I'm going to skip a little bit over this, but as people age, they have to accumulate wealth. And we see in North Asia that people are preparing for an extended period in retirement. And therefore, that's good for banks and wealth managers and these sort of things, and insurance companies. This is a bit technical. I'm not going to go too much into it unless people want to go there. To think about markets, we also have to think about the psychology in markets. Now is a good time, for example. There's complete aversion to Chinese equities. That might be good for China. And sometimes I think in India, we go very quickly from expansion to euphoria. Valuations are a little bit very rapidly, very high. So these things are important as well. Other themes of importance is, of course, the growing tension between China and the US. And in particular, China is focusing on self-reliance in technology, chips, food, oil, therefore focusing on new energy. So those are areas of growth in China. And what is interesting in China as well is that as people age, a lot of people in China are going into their 40s. That means if you had one child, that your child is going to be around 20, 25. That child is therefore leaving home, going to university. You get smaller households, two households, a empty nester situation, as we call it. Very often we're a dual income because women work there. And these people are becoming a very big consumer force in the Chinese market. So if you invest in China, you want to invest in these empty nesters and what they buy. And what do 45 and 50-year-olds buy? They don't buy property or a car because they got that already. And a TV, they got that already. They buy healthcare. They buy sports. It's always the 50-year-old that's running around because they want to try to stay fit, right? Not the 18-year-old because he's fit already from nature. They buy sports shoes and athletics wear. They go to better restaurants. They upgrade. They buy better bottles of wine and liquor. So we see premiumization trends, and that's quite unique in China. And you wouldn't see that too quickly in India because the demographics are simply not ready for that yet. And as I mentioned, another theme is that people are accumulating and preparing for retirement, in particular in North Asia. They're setting money aside. That's good if you're an insurance company. It's good if you're a broker or a stock exchange or a bank. But also we see that, that these people invest in stock markets, and that leads to an increased retail participation in stock markets across the region. India is no example to that. And these people need to get information as well. And that's the whole reason I wrote this book. And the last theme, of course, is in Asia and in India in particular, getting access to the rural areas, because that's where a lot of growth, I think, is going to come from over the course in the next couple of years. So why invest in Asia? Well, there is not such thing as Asia. There's so many divergent trends in Asia, so many different themes. So although Asia in total might not have done as well as the S&P 500, there are easy ways to outperform the broader index. If you understand the dynamics and the construction of these markets, some of the key themes that play in these markets as well. So with that, I'm actually going to go to the very beginning of my presentation. I hope you follow this a bit. I put this here. But this is really an introduction into the Asian stock markets. I hope that allows you to understand these markets a little bit better. If you want to go deeper, I'm on LinkedIn. You can follow us. We do a podcast, which is freely available. You can get that as well. It's called Under the Banyan Tree. I do that together with our chief economist, Fred Neumann. But if you're a finance student or a CFA, if you take this book and your finance knowledge, I think then you really enlarge in your ability to understand these Asian stock markets even better. And with that, I'm going to hand it back to Pranav and see if any questions have popped up.
Thank you, Harold, for this insightful presentation. We'll wait for the questions to assemble. But I think I'll just kickstart this discussion from my end. There are two ways to look at investing in Asia. One is, predominantly Indian families or Indian individuals no problem. Have been investing.
I'm just pouring a glass of water here and it goes horribly wrong. Sorry for that. Sorry, I got distracted. Go on. Sorry.
No, so what I was saying is there are two ways to look at investing into Asia. Usually what has happened in India, people look investing outside India. When they think about it, that is predominantly they either invest mostly in the US because it's an easily understood market. A lot of people keep on traveling, the known companies and everything. So how does one how does one approach investing in Asian markets as an individual or a family office? And the second aspect, which if you can quickly address, that if you are a professional portfolio manager or an analyst, how wary or what you should be aware of when you are analyzing Indian companies and when you are anticipating that there might be some flows which might come from, these regions, because like you mentioned, over the next decade, there will be some realignment of total flows. So
Yeah.
I think quickly, if you can address while the questions start coming in.
Yeah. So first on how to invest in Asia. The US is so easy. That's right. You buy an ETF in the US, you get good exposure, and it's done very well. But you would miss out of some of the opportunities that are around in Asia. And also because of the correlations not being so high, there's great diversification benefits of investing in other parts of Asia. And it's, of course, an area that's very close to us. And therefore, it's something that we understand better. We can go deeper into these markets than people that don't understand them and identify these opportunities. The dispersion in stock returns in Asia is much higher than in the US. So the ability for you as a portfolio manager to outperform the broader index is much higher and better in Asia than it is in the US. In the US, it's quite difficult to outperform the top, say, 5 or 10 stocks or so. You really got to go deep and find other companies that do much better than, say, the Apples or etc. In Asia, that's much easier. So there's an ability to play alpha, as we called it in finance terms, to outperform. That's, I think, where you need to market yourself around us as well. And then you had a second question, and I quickly forgot what it was actually.
As an analyst, if you're analyzing Indian, how do you
companies?
How do you balance that flow? Expect, do you compare them with Indonesian, Chinese, or what an analyst should keep in mind?
Yeah, there's a couple of things that I think are really important if you look at the Indian market only, and still you need to look at the rest of the Asian markets. First of all, China, because China is big and India is big. These stock markets are big. So if China performs well, the money's got to go from somewhere. And we see very often outflows from foreigners out of India because they need to finance their purchases in China. But also, if China doesn't look good, people need to go somewhere else. And India's got a low correlation with China. Therefore, China and India are played against each other in that sense. That, I think, is important. Another thing that's simply important is of course, you do financial analysis and these sort of things, but in India is to understand what you guys call promoters. That in itself is already a funny word because the rest of the world calls it shareholders. Promoters suggest that these shareholders want you to buy, they're promoting their stock already. And very often Indian companies are very good at presenting their companies. So you got to understand where these guys are coming from, what are they doing, and what do they want to take out of it.
No, I think that's good. We have some questions. Can you suggest any long tail risk in any of the countries that you foresee going forward? Anything which one should be wary of?
The long-term risks?
Long tail risk. Any black
tail risk. I think there's a couple of tail risks across the region. Geopolitics is a tail risk. I mean, China is growing, and that has led to tensions with Taiwan recently. It's led to tensions with India, right? That is maybe itself a tail risk. So that's that. From the rise of China, we could find all sorts of things. Things are coming out. Also, we see, for example, that supply chains are moving across Asia to diversify a little bit away from China, maybe to the benefit of India to a certain extent. But it's not always easy to do that, and that might create shortages at one particular point in time or difficulties. It's easy to say, let's do semiconductor manufacturing in India, but actually doing that is much more difficult. And if you rely on India, you might suddenly find out that you have a problem in India that you didn't have in China. So there new risks could come from that as well.
And also we have a question here. How do you view the variable interest entity structure stocks listed in US of Chinese companies, given that no FDI is permitted in China?
Yeah, so that's right. Variable interest entities are basically, you buy a stake in a company that has a contract to get the profits out of China. It's a very unique structure because the Americans don't like it because it's foreigners who buy it, but also the Chinese have never approved this. So it's a kind of odd structure that has worked out, but a lot of the larger tech companies have this particular structure. This could become an area of contention. This could be a tail risk. It's one of these tail risks that we all agree that it's all best that we work with these VIEs, as we call them. But if there's really a head-on collision between the US and China at some particular point in time, it could be that this is an area that both countries are going to look at, and that either China or the US says this structure is not allowed anymore. And you see companies trying to change that. But yeah, that's a corporate structure that's oddly not allowed and not preferred in the US and China either, and could become a tail risk in that sense.
No, that makes sense. What are the tax and other regulatory considerations one must consider when they are investing in Asian markets?
I think the considerations that people very often, for example, for foreign investors, is actually in India that it's difficult to get direct access. You have to use so-called what we call P notes. A lot of other markets, access is relatively easy. The only market is the Asia market, the Shenzhen market in China. We can't access that, but we can do that through the Hong Kong market. There is a select group of companies that you can trade in Shanghai on the Hong Kong Stock Exchange, and something we call Stock Connect. It's a very unique sort of structure that is in place there. Tax-wise, in most other countries, capital gains tax and these sort of things are not taxed very high. So that's not a real issue. But what is unique is maybe the Stock Connect structure in Hong Kong to provide access to China.
Okay. From a geopolitical risk perspective, which of the Asian economies looks the best? As in the least risky, I would assume.
I presume that is least risky. I mean, the rise of China, the growing antagonism between China and the US, and has all kinds of consequences on a variety of industries and sectors. The key areas for us to focus on is food, energy, and technology, because most countries, China, but also India included, want to be self-sufficient in those particular areas. And we see all countries trying to put efforts in place to grow that. And I think as the countries that reduce maybe that reliance might be the lowest risk in that sense. But yeah, Taiwan and Korea nearby. India has got its own issues with China. China is building its own self-sufficiency in the areas that I mentioned. So yeah, it's risks that are associated maybe with developing those industries.
Great. We have some more questions. I know we have a hard stop at 6:30. How does the market in India differ from housing market in China?
I think the housing market in China differs from India. One, in China, there's too many houses for too little demand. So the housing market is really a struggle. It's been over-financed. It's been used as a source of urbanization. And in India, that is much less so the case. I'm not quite sure of how you purchase houses in India, but a lot of it has gone through the primary market in China, meaning people pay up front for a delivery of an apartment or flat later in the future. And that comes with all sorts of associated risk if your developer goes bust. I think in India, that might be a little bit less so the case. In India, I would see the housing market and financing mortgages as an opportunity, as growth. And in China, it's clearly a risk at the moment.
Yeah, and I think in India, we have had a lot of regulations over the last couple of years addressing the developer problems and things like that. So
India, I mean, this is a key point. India has been able to clean up its non-performing loans over the last years, and the NPLs have come down considerably. And in China, that's still really an issue. And that makes India, from a bank point of view, also look much more interesting than China in that sense.
I think we can take two or three more questions quickly. I'll just try to rephrase this one. How do you see the recent outperformance of Indian market compared to US market over the, let's say, 5-6 months? Do you think the outperformance will reverse, or India will catch up, or US will catch up?
The Indian market is fairly unique in that across the world, the outlook for growth is not very good. In Europe, it's coming down. In the US, it's expected to come down. In China, it is improving, but it comes from a very low base, and there's a lot of uncertainty to that. And in India and other markets as well, in India, the visibility on earnings growth is really good. You have a consumer that is recovering. There's a capex cycle recovery. We just spoke about up their balance sheet, and therefore they can extend credit again. So the visibility on earnings growth is really good. And that, I mean, earnings growth is one of the drivers of markets. Other drivers, as I mentioned, is discount rates and risk and these sort of things. But from that point of view, India stands out. And it's probably one of the reasons why India is also trading at a premium versus the rest of the region. But that's pretty good for India for the moment.
Okay, I think we'll take the last question here. Considering the flows from US into Asian markets, how much do you think passive funds contribute versus active funds, especially in the Asian markets?
Well, that will change over time. At the moment, I think it's mostly active funds that are coming into Asia. Portfolio managers actively looking at this. If there would be a peak in US interest rates, if interest rates in the US would start to come down, if the strength of the dollar would diminish, or maybe the dollar would weaken, that would be positive for Asia. And I think that more money will come into emerging markets in Asia under such a particular scenario. And I think a lot of retail money will then also come, and they will use ETFs to build exposure. ETFs, country ETFs or regional ETFs or sector ETFs in order to build that exposure. And at under such conditions, I think passive money could suddenly become really big as an inflow into the region.
Oh, great, Harold. This was the last question. Thank you so much for sharing your insights with us today. As a reminder to our listeners, please do complete the evaluation survey that appears at the end of your screen at the end of the session. CFA Society India members may claim professional learning credit by logging into their online professional learning tracker tool. Thank you all for participating in today's webinar. Thank you, Herald. You have a nice flight ahead.
Thank you very much. And if anybody still has got questions, they can reach out maybe through LinkedIn or something like that in order to reach out, and I will try to address those questions that were still outstanding. Thank you very much for having me on.
Yes, great. Thank you, Herald. Thank you, everyone. Goodbye.
Goodbye. I think we stopped recording. I'm not quite sure. But hey, Pranav, I want to thank you very much for hosting